Hello everyone, this is the Professor Zhao. In this chapter, you will learn the relationship between the economy and the stock market, analyzing macroeconomic factors that affect the stock markets and approaches to forecasting stock market trend. The fundamental analysis for stock follows a top-down approach, which consists of three levels of analysis, namely economic analysis, sector or industry analysis, and individual stock analysis. The top-down approach starts with economic analysis. To analyze the economy, one needs to look at the U.S. domestic economy, GDP, which measures total amount of economic activities. As of year 2014, U.S. GDP is about 17 trillion US dollars, the largest in the world. Yet, the most important thing about GDP is not its absolute size, but its growth. The growth of GDP has tremendous impacts on stock market performance. Nominal GDP growth may mislead investors due to inflation. The real GDP growth reflects true economic strength because it has been adjusted for inflation. Business cycle is the recurring pattern of economic expansion and contraction. It often explains ups and downs on the stock market. A full business cycle goes from trough to peak and from peak to trough. When economy is going from trough to peak, we call it as economic expansion, like the one that we experienced for a period from year 2009 to year 2014. When the economy is going from peak to trough, we call it as recession, like the one happened during a period from year 2007 to year 2009. National Bureau of Economic Research tracks the U.S. economic activity based on business cycle. It officially determines the turning points from one cycle to another. Since business cycle explains stock market trends, investors are very interested in forecasting stock market based on business cycle. Is that possible? The answer is yes. Many statistics associated with various economic activities can help us make forecasts. Those statistics are so-called economic indicators. There are three types of indicators: leading, coincident, and lagging indicators. Only leading indicators have the forecasting power. The composite economic index can also be used to indicate peaks and troughs in the business cycle. Other than GDP and the business cycle, investors can keep close eyes on monetary policies implemented by U.S. Federal Reserve. The Federal Reserve's decision on interest rates and the money supply have huge impacts on stock market performance. Stock markets tend to do well when the Fed is dovish under accommodating monetary policies, such as low interest rates and high level of money supply. The stock markets tend to decline when the Fed becomes hawkish under tightened monetary policies, such as rising interest rates and a low level of money supply. Several rounds of quantitative easing, or QEs, conducted by the Federal Reserve during year 2009 to year 2013 are typical examples of accommodative monetary policies, aiming at rejuvenating the economy. S&P index increased from 825 to 1805 during that time period. That is 118% again in just 3 years. From GDP growth, business cycle, and Fed's monetary policies, investors have many things to analyze the economy in order to forecast the next move on the stock market. What else? Well, don't forget the yield curve. The shape of the yield curve suggests an expanding economy. A flat structure hints an economic slowdown, and a downturn sloping yield curve indicates a recession. The economy is the foundation for the stock market. There is a very strong relation between them. Understanding the economic situation is very helpful for investors to forecast stock market performance. Yet, empirical evidence shows that stock market performance itself forecasts economic activities. Stock prices lead the economy. In the past, stock prices forecast economic recoveries better than it does for recessions. Stock market booms occur when economy grows rapidly. Stock market slows down when economy doesn't do well. A typical bear market declines more than 20% during an economic recession. To forecast future stock market index, investors often use P/E ratio approach. The estimated stock market index equals assigned P/E ratio times expected earnings per share for all stocks in the index. The method looks very straightforward, yet a consistent, successful forecasting based on its approach is futile. First, the forecasting of earnings is always challenging. Second, P ratio is affected by many factors such as interest rates, inflation, and growth rates. There's a strong relation between business cycle and the stock market performance. Generally, stock market begins to decline when business cycle is approaching its peak. Stock prices often begin to rise when the business cycle approaches trough. Therefore, forecasting turning points in business cycle could be helpful for investors to forecast the next movement of the stock market. Yet, stock market index tends to be a leading indicator of business cycle. Investors often use Fed model to decide where to invest their money, stocks or bonds. The Fed model compares the yield on long-term T-bonds, say 10-year T-note rates, with earnings yield of the stock market, also called EP ratio. If a bond yield is greater than stock EP ratio, then the bonds are more attractive. Otherwise, stocks are more attractive. For example, in March year 2015, 10-year T-note rate is 2%, and S&P EP ratio is about 6%. In this case, stocks are more attractive to bonds. This model works well on average over a 30-year period also, but does not fare well when interest rates are very low. Other models to consider to accessing stock market direction associated with the market P ratio, interest rates, monetary policies, volatilities, and the calendar effects such as January effect, and so on and so forth. This is Kevin Zhao. I hope you enjoyed this video, and I see you in the next class. Hello everyone, this is Kevin Zhao. After reading this chapter, you should be able to understand the difference between technical analysis and fundamental analysis, to evaluate some typical techniques used in technical analysis, and to decide what role technical analysis might play in your investment. Technical analysis uses market data to analyze both aggregate market stock prices and individual stocks. It ignores the fundamental information such as sales, earnings, growth rates, and so on. It pays no attention to stocks' intrinsic value. In some extent, it casts insight into the psychological dimension of the market. For example, the impact of investors' sentiment on stock prices. Technicians believe that supply and demand result in particular stock price pattern. Stock price charts are of great value to identify trends and patterns, and to detect trading signals. The Dow theory is the oldest and the best-known theory of technical analysis. It defines three types of stock price movements: primary move, secondary moves, and the day-to-day moves. The Dow theory suggests that the bull market occurs when successive rallies penetrate previous highs and declines remain above previous lows. It also suggests that the bear market occurs when successive rallies fail to penetrate previous highs and declines penetrate previous lows. The Dow theory defines secondary moves as technical corrections. It believes that day-to-day moves are of minor importance. The Dow theories aim at forecasting the starting point of primary moves. It's a very attractive theory for investors. However, the success of its implementation is questionable. The same market data may suggest conflicting movements. This graph demonstrates an example of primary move and a secondary move based on the Dow theory. Technical analysis try to identify the trend of stock price movement by identifying the trend line between the supported level and the resistance level. Both the bar chart and point-to-figure chart can be used to identify stock movement trends. The moving average is one of the most popular technical indicators used by technical analysts. Comparing the short-term moving average and the long-term moving average can generate trading signals. When short-term moving average crosses the long-term moving average, it indicates that stock price will move up, sending investors signal to buy. When short-term moving average crosses the long-term moving average, it signals a sell. Relative strength is the ratio of price to index or past average price over some period. Rising or falling ratio indicates relative strength or weakness. Breadth indicator measures the net difference between number of stocks advancing and declining. Plot of running total across time is compared to a stock average to analyze any divergence. Divergence implies trend changing. High trading volume is a bullish signal. Short interest is the number of stocks that have been sold short but not yet bought back. Short interest is a typical investor sentiment indicator. Generally speaking, high short interests is a bearish signal and a low short interest a bullish signal. Yet, sometimes high short interest may be explained as a bullish signal because more short positions need to be covered in the future and the stock price may be boosted due to short covering. Contrarians trade in the opposite way of most investors based on the belief that if most investors are buying or selling into stock, then the stock's more likely to be over or under priced. Bearish sentiment index is a ratio of bearish financial analysts to total number with an opinion. Typically, the bearish trend is identified when the index is between 55 to 60%, and the bullish trend is hinted when the index is above 20%. Put-call ratio is the ratio of number of traded put options to the number of call options. Assuming call or put option investors are bullish or bearish about the market trend, the high or low put-call ratio suggests a downward or upward market trend. So far, we introduced the 9 different technical analysis techniques. Do they work consistently for investors? To test the effectiveness of those technical trading strategies, we needed to look at many factors such as transaction costs, risk, and consistency in performance. Unfortunately, academic studies generally do not indicate that technical analysis works. Efficient market hypothesis poses many challenges to technical analysis, yet there are some new evidence supporting technical analysis. For example, the momentum trading strategies that academics discovered in the late 1990s. To conclude, although technical analysis is still popular among individual investors, there's no consistent evidence suggesting its long-term success. Most technical indicators may lead to conflicting explanations. The weak form market efficiency hypothesis suggests that technical analysis is of no use in forecasting stock price. This is Kevin Zhao. I hope you enjoyed this video and I'll see you in next class.